All right, welcome everybody. Welcome to our next Ask Alliance, Credit Check Friday, debunking the myths of credit. So today we have John Warren here, mortgage lender for A Plus Mortgage. And today he's going to go over anything from how to build credit, what is bad credit, and everything in between. So he has this tutorial of all of that information. So welcome, John.
Thank you for having me.
Yes, pleasure for you to be here.
So I guess I'm going to kick it off. Credit, our best friend, our worst enemy. I know that there are 5 components that control our credit score. Can you help share what those 5 components are?
Absolutely. Let me just pull up my screen here. I'm going to share this to go over it to give a good visual here. Everybody see that? So when I look at a credit, there's only so much of your credit score you can actually control. So the largest portions are what I always focus on with any client. Payment history is 35%. That's something that is controllable. You can pay your bills on time, and it's going to have a great effect on your credit report. It does take time. So if you do have a hiccup and you have some delinquencies, it's never too late to start paying on time again and starting that clock of having on-time payments. The other large portion that's a lot of times underutilized by people is the amounts they owe on their credit cards, for example. I have a lot of clients where they might be a younger student in college, and a lot of times those types of credit cards, they have small balances, like maybe $1,000, maybe $500. And it does not take much to really use a lot of the percentage of your credit line on an account like that. So by simply just filling your gas tank 3 times in the month, that could easily be $100. And if you have like a $200 credit limit, that could be problematic because you're carrying a really high balance proportionally to that card. So one thing to always be mindful of with this 30% factor is to pay attention to what your credit limits are and try to keep those balances under 30% of that. And that's going to have a great effect on your credit. And a lot of times that can have an immediate effect. Quick story on that. I had a client that maxed out a credit card. He was 21, shopping for a mortgage. He had $1,000 limit on the card. He maxed the card out buying a computer for $800. His credit score dropped from mid 700s to low 600s instantly. Now we were able to correct that credit by paying that card down to a lower balance. But when you're young and you don't have a lot of credit history, that really can count against you heavy. So you want to be mindful of that, especially if you're going to be going to buy a car, apply for credit cards, or even a mortgage, to keep an eye on those balances before you're going to do those things. So I like to think of that 65%, the amounts owed and the payment history. That's something we can do very much so today to improve our credit. The other 3 factors are 10 and have the weighting of 10% is new credit. That's not always for everybody. We're not going to just go open up a bunch of credit cards to try to improve our score or get car loans or get things that are not necessary. So for that, I consider that more of an uncontrollable category because we're only going to apply for credit when it makes sense. The length of history, this is something that young people can't control as much, but older clients can. A lot of times you might have a credit card you haven't used in 10 years and you're thinking about closing that account because you don't use it. That would be bad on your credit. And the reason being is every card is weighted. How much time have you had it? Have you had it 10 years, 5 years, 15? And when you take away some of those long-term accounts, the length of your credit history is now reduced. You don't have that card reporting anymore. So even if it's 0, it's much better to keep the card. If you insist and you're worried about someone stealing, you can always reduce the credit limit on that card and just not use it. And that way, if there was ever an event where someone got that information, they couldn't max it out as high as the previous limit. And the last one to be aware of is your credit mix. That's 10%. credit mix will be like a credit card, a car loan, a mortgage, student loans. It's really good to have a mix of that. And even within credit cards, you have different mixes. You have like a store credit card, like TJ Maxx card or Kohl's card. And then you have your standard credit cards like MasterCard, Visa that aren't branded by an individual store. But this basically makes up 100% of your score. And I always tell people that they have 65% control of that score today.
Great information. Good to know. Thank you.
You're welcome. Any other questions on that?
The question was
Yes.
going, but you were muted. Yeah.
Sorry guys, I was muted. Yeah, I just realized. So John, I've got the next question here. So let's say your credit looks good, everything looks good. You now have a pre-approval letter in your hand. You are ready to go shop for a new house. What are some of the things or things not to do when you got that pre-approval?
Perfect. Yes, we get that question frequent. So every time we have a client, I hand out a mortgage guide brochure. It's 5 pages. It tells basically the documents you need, what a pre-approval is, mortgage loan process, and then what I have on my screen is the things to avoid when buying a house. It's very easy to think that, it doesn't matter. It's a small credit card or this or that, and it does matter. So biggest things we care about are if you have employment, don't change employment without counseling your lender. There's a lot of situations where you can, get a better job during the process. It happens every day, and that's perfectly fine, but communicate to the lender first so we can tell you if that would jeopardize your pre-approval. In many cases, it will have no impact at all. But if it does, you want to be aware so you can make a decision accordingly. Other things, you definitely don't want to apply for any form of credit once you have that pre-approval. You don't want to apply for credit cards. You don't want to apply for loans, student loans, etc. If you want to shop a lender, that's perfectly fine. That's not going to jeopardize your pre-approval. Shopping rates, the credit bureaus are aware that savvy buyers will shop rates. So you never have to be afraid to get a second opinion or even a third opinion with your lenders. But as far as all the other forms of credit with the car loans or anything else that would pull your credit, that would have a negative impact on your application and could jeopardize the pre-approval altogether. So it's very important to have that conversation with your lender. It doesn't mean that you can't apply. It just means you need to consult your lender and they'll review your file and let you know if you're good to go with that. Again, like we went over with the credit makeup, it's very important. Keep paying your bills on time. Don't add excessive balances to your credit cards. Use them as you normally do, but don't go and buy $5,000 of furniture on your credit cards or apply to get furniture. A lot of times you'll go to a store and they'll advertise a 0 interest option, which might be very appealing. But what you may not know is that they might be opening a new line of credit, and that could be very problematic for your loan application. I would say those are the major things to worry about. The last 2 things I want to go over is if you own a business or if you have a loved one, you never co-sign for any type of loan during your process of shopping for a mortgage. What does that mean? It means if you have a business and you have to be the personal guarantee to buy the car or to get some type of loan, that's a problem. And if you're going to do it, you need to discuss that with your lender to see what effects that would have on your application. And then any other type of co-signing, whether it's for a family member or friend, same thing. It doesn't matter if it's for a business or a family member or friend. It's as if it's your loan, which can have a profound impact on your loan application.
Awesome. That's good info. Good. Yeah, thank you. Appreciate it, John.
Thank you.
All right, I got the next question. So what are the 3 reporting companies that monitor credit and why might they have different scores?
Absolutely. So we have 3 credit bureaus a lot of people are familiar with, and all of them are different entities. So they're not in cahoots. They don't get the same information. It costs money to report to a credit bureau. So a lot of times, let's say you have a We Energies bill when they used to report on your credit card. I mean, on your credit accounts. They might have reported to TransUnion, but they didn't report to Experience or Equifax. So our three credit bureaus are TransUnion, Experience, and Equifax. They're all separate entities. They all have different ways of measuring the information on your credit report, and they all collect information differently. So you can see a wide spread on your credit score range between each account. For example, TransUnion could be 700 and Equifax could be 600 or lower. And the reason for that is they are separate. They operate independently and they all process and report their information differently. So if you, going back to the We Energies example, if they only report to TransUnion and you miss a payment, well, only TransUnion knows that you missed a payment on a We Energies account. So Experience and Equifax might have a really high credit score for you, let's say 800, but now you have this missed payment reported to TransUnion, and that score is, let's say, 700 or below 700. So you can get a wide spread. You never know what company is reporting to who. So a lot of times with collections, because it does cost money to report to the bureaus, they'll only file it with one bureau. So you might have a lower score on that collections account for Equifax or Experian. It depends who they report it to, but there's no way of knowing who they'll report that to. So it's very easy to have a really wide spread of scores. The most important is, what score do we use? You know, so let's say you do have a 600 for that TransUnion, but Experian and Equifax are 740 and 745. We're going to take the median score of the three. So we don't average them. We don't add up the three and divide by three. We just take the middle score. So if 740 and 745 and 600, we're going to take that 740. That's the median score. We don't care about what bureau it comes from, whether it's TransUnion, Equifax, or Experian. We just care about the middle score. And that's how, as lenders, we use your credit report.
Thank you.
You're welcome.
Can I ask a follow-up question on that quick here, John? So if the lender says, hey, we look at TransUnion, we don't look at the other three, does that mean they indeed not going to look at the other three and just base their opinion off of TransUnion, or they're still going to look at all three and base the score, take the median score to kind of see if you're eligible or not for a loan?
So in regards to mortgage lending, so applying for a home mortgage, we're required to report to all three bureaus. So mortgages is one of the federally regulated thing. They must report to the three bureaus. That's not the case with all credit cards or collections in those accounts. So whenever it's coming to a mortgage, all three scores are going to be on our credit report, and we get what's called a tri-merge report. It shows all three of them and breaks down all of the scores, what accounts are in there, if there was any derogatory marks, etc. And we do use all the information within the report in making our decision. So if a lender for a mortgage was telling you they only use Equifax, either they're not telling you the whole story or they're not telling you correct information.
Okay, thank you.
Hi, John. So, how long does it take to repair bad credit? And what are some actions that negatively impact your credit score?
Yeah, so that is a very, very good question, and it's asked very frequent. So a lot of times there's no straight answer as far as missing a payment. You know, there's always those sayings you hear that if you miss a payment, it's on your credit report for 7 years. However, from a lender standpoint, a lot of times we're not very concerned with certain types of missed payments. Let's say you have medical bills and collection. I see that on a large portion of my applications, and rarely does it have a negative impact on the application for credit score. It's more so an impact for the debt to income that we have to assess for the client. So not all missed payments are bad payments, because you want to be on time, but there are worse missed payments than, let's say, like missing a medical payment. That's a lot easier to come back from than missing a mortgage payment. If you miss a mortgage payment, now you might have to wait. We might have to wait 6 months, maybe a year. We have to assess the history of your payment schedule when it comes to mortgages. So if there's one payment to not miss, you never want to miss the mortgage payment. All other payments that you miss, whether it's a car loan, a credit card, etc., it's going to affect your credit score. But other than that, a lot of times we can still get you approved for that mortgage. So don't think for a second that if you have one missed payment that you're no longer going to be able to get a loan. It's just going to affect your credit score for the short term, and then it will gradually improve as you continue to make those on-time payments. So any other questions with missed payments?
No, I'm just wondering that, you know, if it's possible to estimate how long it takes to repair the impact of a missed payment. Is it possible to kind of at least know the range of time for that?
It's really dependent on the situation. So when us as a lender, we pull your credit score, we also have a software that tells us how we could improve your score if need be. Let's say we pulled your credit and you did miss a payment and your credit score is 600. A+ mortgage cannot do anyone below a 640 credit score. So we have a software that will say, hey, you know, wait 2 months and pay these bills on time, and the credit score, repull credit, and credit score should be, let's say, 660, and now you can get approved. As far as an exact timeline, it depends on the credit makeup of the person. If you only have one credit card and you miss a payment, that's going to take a really long time to come back from. That's not going to change in a month or 2 months. It's going to be several months to a year plus. If you're someone that has 10 credit cards, mortgages, and loans, and everything's on time and you miss one payment, you might see a negative impact of 30 to 50 points on your score. So maybe you drop from 750 to 700. And yeah, you don't get as better of a rate on the mortgage side of things, but in no means is your application jeopardized, and you really don't need to wait a long time to see your score improve once you start paying that bill on time again.
Awesome. Thank you.
Welcome.
So, another question, John. Why is it a good idea to get a pre-approval as soon as you start thinking about purchasing a house? And what would happen if this pre-approval expires?
Great question. So going along with that, I always have two concerns. The largest concern we see is people don't want to apply and get pre-approved because they're scared of having a hard inquiry on their credit report. And then they're worried that, let's say they're 6 months away, that a pre-approval is typically good for 90 days with most lenders. So that means their credit is going to be pulled a second time during the duration of their home shopping. So those are the major concerns. However, most of the time, those aren't founded on good principles. I tell every client that if they're even thinking about houses, they definitely need to get a pre-approval. I normally recommend 6 months prior to when you're ready. Reason for 6 months is if you do have something on your credit report, it's going to tell us, and we're going to be able to work through it. And rather than you sign up with a real estate agent, you have a home search set up, you find a house that you really love, and now we have to do a mad dash of document collection, getting an application, only to find out there was something on the credit report that could have been repaired, but because of this narrow window of 24 hours or 48 hours, we're not able to give you a pre-approval to get you in that house. And so it leaves for a broken heart at the end of the day for most clients. So as soon as possible, get your pre-approval. The credit bureaus know when you're shopping for a mortgage. you can have several lenders pull your credit, and it, in most cases, is never going to have an effect. It only counts as one inquiry. So if you shop A+ Mortgage and US Bank and Chase Bank, just to see who's going to give you the best rate, who's going to give you the best closing costs, those matter. That's money in your pocket. And everybody should be a sound shopper and not be scared to shop some lenders. So the credit bureaus know you're a savvy person's going to shop rates. So they allow for any number of inquiries for typically 45 days, and it only counts as one hard inquiry. So although several people pulled your credit, they only weigh that on your credit report as one credit pull. And likewise, when you have a pre-approval and you have to re-up it in that 90 or 100 days, and we re-pull credit, they can see that that same person is pulling your credit for the same loan application, and it's not weighed heavy. I pulled credit 3 times every 90 days for some of my clients, and their score has not been impacted more than 10 points during the duration of 270 days of pulling their credit every 90 days. So the credit inquiries are nothing to fear as long as you're only shopping for a mortgage. If you're shopping for a mortgage and a credit card and a car loan, everything goes out the window. Those are all separate inquiries, and that will have a negative effect on your credit report for the short term. Credit inquiries do not last long. A lot of times you'll see your score rebound as soon as a month or two after having a hard credit inquiry.
Thank you, John.
You're welcome.
Yes, thank you so much, John. My question came from the audience and you answered it. So it's actually, I'm so glad this is being recorded because we hear that question so many times. Well, how is that my credit is going to be impacted by pre-approval? And yes, we're going to have this hard-coded now. Anytime they sign up with us to look for a house, we're going to tell them, please listen to this video first. You're going to be just fine. Go and do a pre-approval first. So my question is answered. Thank you so much.
Yes, and on top of that, you know, for those that might not just trust the word of someone on it, which I totally understand in today's market, part of the presentation here, I don't know if people can see what's on my screen in the back, but here's 3 links that go over your credit inquiries. Like what happens when you have your credit check? This is directly from Consumer Finance. It's a government organization that regulates mortgage lenders, CFPB. So their information is 100% legit. It has no affiliation directly with doing lending, but regulating lending. And also you can check on TransUnion, Equifax, or even in FICO, and they will all say the same information about this grace period for those inquiries when you're shopping rates.
This is awesome. Thank you so much.
All right. So you mentioned just before you were talking about hard inquiries. What's the difference between a hard inquiry and a soft inquiry, and how does that impact credit?
Absolutely. So I get that question very frequent. And there was a time a year ago where we were able to do soft credit pulls to kind of do a preliminary search on someone to see if they would qualify without doing a hard pull. And that was put to the end. The regulators didn't like lenders doing soft pulls to do that. We have to do a hard pull now. So the main things are when you're doing a hard pull, that's going to be applying for your credit cards. That's going to be applying for a loan. That's going to be applying for your student loans, anything like that. A soft credit inquiry would be things like applying for rent and they do a background check on you and check your score, or you checking your own personal score, or let's say you're shopping rates with your insurance provider. They typically pull a soft pull on your credit just to do a preliminary search of you. They're not really extending any form of credit by providing insurance. So the biggest way to decipher it is, are you getting credit extended to you like an account that would be reported to a credit bureau? If it's not like that, then odds are that source would not do a hard inquiry on your credit.
In addition, you talked about if you pulled your own credit score, that would be considered a soft pull. So how do some of these as a curiosity, how do some of these reporting companies like Karma Credit that supposedly pulls your score, or many times our credit cards now, you can pull your score when you sign into your Citi account or whatever. Is that accurate?
So that is a loaded question because it really depends. I have had the inverse in both situations where someone had a Discover credit card and the card statement said their score was 800, and as a lender we pulled it and it was 660. And then I've had the inverse of someone where their card statement and Credit Karma said their score was in like the mid six, I think it was. We pulled their score as a lender and it was 720. So it's a gauge of where you're at, but it's not always accurate. So those are two extreme examples, and that's rarely the case that it's that extreme. I want to make that known. They're not trying to fraudulently make you believe your score is something. It's just sometimes they're pulling information and it's missing certain pieces that are very important that screw up their algorithm, and then they spit out an inaccurate score. But for your average person, for example, I just refinanced through A+, my own company, 2 months ago. My Discover and Citi card said my score was 801. When the lender pulled my credit, it was 802. So it was very accurate with what my cards had versus the lender. So you can definitely be accurate, and sometimes you can be extremely inaccurate. It really depends, maybe at a recent missed payment that it didn't pick up, or some derogatory mark, or it's just not collecting some piece of information that makes the puzzle complete.
Got it. Thanks.
All right, now that we all know John's credit score, we can move on to the next question here. Hey, John, so how do you establish a new credit, and then is all credit bad, or can you still use some of your credit and it's not going to be considered a bad credit or against you?
Yeah, so I work with a variety of clients. So I'm going to go from an extreme. I work with some clients that do the Dave Ramsey program. Anybody who's familiar with that program, it is very adverse debt, which is a great thing, right? Being debt free is part of the American dream in a sense, right? It's a form of financial freedom, not having debts. However, if you're young and you start a program like this, and let's say you're 25 now and you haven't got any credit cards or student loans or car loans, you don't have a credit score because there's nothing that has ever reported to a credit bureau. Therefore, when you go to apply for a mortgage, most lenders can't do your loan because literally it will show 0 scores across your credit report and it will show 0 accounts. I've just had one last month like this. And there are lenders that can make up trade lines, which would be like, give me 24 months of proving that you paid your rent on time and 24 bank statements to do it. However, A+ Mortgage is not one of those lenders, and the lenders that typically do that do not offer the premium rates and cost associated with a well-qualified borrower. So in your question, it's great to have no debt, but if you don't have any credit, you need some form of credit. Now, that doesn't mean go get a credit card and max it out and go get a car loan for an $80,000 car. No, it means we got to be responsible with our credit. And that means let's get a credit card and let's just put our groceries on it once a month and then pay it off. Debts that we would always pay from our bank account every month regardless. You don't have to go buy a new TV and a new computer just because now you have a credit card and a credit limit that allows you to do it. You have to exercise some discretion and discipline and, use the credit to build your credit. So it's okay to open up a card. It's okay to get a car loan temporarily so you can build a credit. Yes, you're paying interest on it, but building that credit's so important because it will save you thousands or tens of thousands on your mortgage when it comes down to your application. So that's an extreme example, someone with no credit that intentionally chooses to have no credit. But what about the people that are 18, they're graduating high school, they really haven't had an opportunity. They can't even apply for a credit card, or they just turned 18 and now day one, they can legally apply. In my experience, if you're young and applying for credit, you have to apply for realistic credit. What does that mean? It means don't apply for that Chase Sapphire card that says it's going to give you 60,000 points that are worth $1,000 in travel. Very appealing. That's great. But I can tell you that most people won't qualify for that card if they don't have credit. What you want to do, go to your local bank, get a US Bank student credit card. You're going to get a very low limit. It might be $200. It might even be $100, but it's a credit card. And then just put $20 on it every month, pay your balance off at the end of the month, and keep doing that. And you're going to start accruing your credit. And that's going to help you to have a credit score. So when a lender pulls your credit, you have a chance of getting the loan. It typically takes 6 months, sometimes up to a year, before you get assigned credit scores once you open that first account. So most people it's 6 months, but sometimes it does take longer. It depends on who you get the card through, how they report it, etc. So that's always a great place to start. Now, some parents that are comfortable with their children being an authorized user, this is a great way to establish credit before they become of age of getting their own credit cards. So if you're 16 years old and you trust your teenager and your teenager's responsible, you can add them as an authorized user on your account. Now, this is only beneficial if the person who is the primary holder of the card has decent credit and pays their bills on time. If you're an authorized user and that person isn't paying their bills, that can actually have an adverse effect on you. So it takes two reasonably responsible people, the child and the adult. Otherwise, the system doesn't work with that. But in many cases, I know my parents added me as an authorized user because I was doing a business while I was in high school and they trusted me. And that allowed me to have a high 700 score right out of high school because I was an authorized user on 5 accounts. And all those accounts were paid on time and they never max leverage debt. You know, you still got to worry about that credit utilization. Remember the credit chart, 35% is payment history, 30% is that credit utilization. So if you have a parent that's maxing that card out every month, that may not be that beneficial to be that authorized user. And then a lot of times when you graduate, you're going to get some student loans, pay those on time. Pay those bills. That's something that you basically are guaranteed to get the loan these days with student loans. So just pay it on time and keep chugging away at that debt as it comes. But those are some simple ways for young people. As you get older, you know, having those cards and you have a history, you're not so concerned about opening new debt. It's really just managing, paying your stuff on time, and watching your credit utilization.
Okay. So yeah, start early, start slow, start with your local bank if you want to get a little credit card to get the credit going. And no, you don't get 150 points just for having a pulse, apparently. If it's a 0, it's a 0, and then that's where you're starting at. Okay. All right. Awesome. Thanks, John.
Yeah, so actually you answered my question before about how to build credit for like an 18-year-old, but this is something that I was thinking about because I wasn't sure if it actually works. So so you have like, I was 18 years old and I have like a debit card, but then you can actually authorize that to go as like credit. Does that actually build up any credit via that way, charging it as a credit, even though it comes right out of your account right away?
Not that I'm aware of.
Yeah, that is a random question because that's what I did when I was 18 and I was applying for credit cards and I eventually was able to get one when I did that. I wasn't sure if there was an actual like if it was known or if it was just this weird logic in my head.
Sometimes what banks offer is a credit builder card. Basically, let's say you have $1,000 in your bank account, they will give you a credit card that you can never exceed what you have in your bank account, and it's going to be a predetermined amount. It's not going to fluctuate month in, month out. So if you have $1,000 bank balance, maybe they give you a card that does $200 a month or $500 a month, and then it just comes out of your account to pay that automatically. And they do have credit builder accounts like that. But as far as running a debit card as a credit, that's just how it's processed on the back end from what I know. So running a credit costs more money per transaction. You get the transactional fee. It's typically like 2 to 2.5%, versus when you run a debit, it's more like a cash transaction, and the fee is greatly reduced for the store or business.
Okay, thank you.
So I got a question here. What is the impact on credit between a short sale, foreclosure, or bankruptcy?
Yes, so I have put together what we call as lenders a seasoning chart right here. So when life happens, because it happens to all of us, right? At a young age, I got cancer, and that put me out of commission for a while. So there's reasons why you might not pay your bills, not because you don't want to, but because the choice is better to not pay the bill than to pay the bill. So life does happen for all of us. As far as timelines are concerned, your longest timelines are going to be with your conventional loan products. Conventional is a fancy way of just saying your standard loan, the one that you go to US Bank or Chase or any bank, that's the loan that they typically give you. Then you have your more lenient loans, like an FHA loan. This is a federally backed loan. The government's backing the loan, and it basically gives an incentive for people that might have had life happen to them. It does cost a little bit more. Rates are typically a little bit higher for it, but it allows you to get in a home quicker. And same with the VA, they're much more lenient when life happens. So going over some of the seasonings, some of the basic ones to keep in mind, if you had a bankruptcy, it's typically 4 years, whether it's Chapter 7 or 13. If you are one of the people that successfully complete a Chapter 13 bankruptcy, that means you honored the agreement you made in the courts, you paid all that on time, and you continue to pay your bills, it is possible to get a loan in as little as 2 years from that discharge date. But I want you to know in the presentation here, there's the discharge date and dismissed. Discharge means that you successfully completed that bankruptcy. You honored the agreement. Sometimes we can't honor the agreement, it's too much, and so it gets dismissed and those debts are wiped away from us. And that when that happens, you need to wait longer. You're looking at the 4-year time frame in order to do a standard conventional loan. And if you are unfortunate enough to have more than one bankruptcy, then it's 5 years from the last one. Nothing you can do about it. The worst thing you can ever have is a foreclosure. It has the longest time frame, regardless of the loan product you use. For conventional, that's going to be 7 years. So that's a really, really long time. It doesn't seem long, but it's long. If we're going to go with an FHA product, the reason why we typically don't counsel people to FHA, but it is a great product that will get you in a house, is with the market conditions the way they are. FHA loans have much stricter appraisal guidelines. And so sometimes it's your listing agent might not like seeing an FHA deal versus a conventional for the exact same amount. So if you can stay away from FHA, it's very appealing because the appraisal process is much simpler with conventional and there's just less hoops to jump through. But if you need an FHA, it's there for you. I have people successfully get homes every month with an FHA loan and come to the closing table all the same. Typically, one thing to note, if bankruptcy terms, very lenient. Chapter 7, just 2 years. If it's Chapter 13, it could be as little as a year, but that means that you have to be 100% on time for all of your payments for that year. If you miss one payment during that 1 year time frame, you have to wait the 2 years. There's no exception to that. And then foreclosure or a short sale, it's 3 years. So that's a much more doable time frame for when life happens, because we all know the housing crisis happened, the crisis that happened in 2008, 2009. There were a lot of foreclosures of people that did have good jobs, and life happened and they had to make hard decisions. And so that was a heavy utilized loan here for many people during that 7-year window because they couldn't get in a conventional loan. And then VA is always a great loan. It requires 0% down and has the most lenient time frames on that Chapter 7, 13, and even on a foreclosure. It could be as little as 2 years. And as far as Chapter 13 bankruptcy for a VA loan, you could, in theory, get a VA loan the day after you had a Chapter 13 bankruptcy discharged.
Okay, thank you. That's a lot of very useful information right there.
John, did we have any other like information that you would like to share with us as far
Yeah.
as?
I have one thing. So why does it matter to have good credit is one thing I wanted to go over. And I think I built this because I felt like $250,000 is a good median sale price for the greater Milwaukee area. It's a lot of your starter home, but what does it mean to have good credit? So I made this chart and I'm hoping everybody can see it. Tier 1 credit for a lender is 740 plus. So whether you have 800 or 760 or less, if it's above 740, you're going to get the best rates for your loan application. So basically, I took the pricing model that we have. I shopped all of these rates last night, so these are very accurate. If you have a 740 credit score last night when I shopped these rates, you were going to get a 3% rate. Now that rate might seem high, but rates have jumped 0.5% in the last 30 days. So rates are constantly moving. If you have a 720 to 740, you're going to see that rate jumps an 8, and then it jumps another 8 as we keep going down these credit tiers. And aside from just getting a better rate, the thing I want to bring most attention to is on the right here. When you do your down payment, I would say most of my first-time home buyers fall in the 10, 5, or even as little as 3% down. Now, I didn't make the chart for the 3% down, but the thing I want to note is look at the difference in what your private mortgage insurance is, which is a requirement on any mortgage where you pay less than 20% down. This, in essence, protects the lender in case of a default on the loan. So if you have great credit, you're talking a very little PMI, under $30 for a 740 score, and it could be as high as 240 if you have that lower 640, just below 660. And the reason why that matters so much is that is money that is lost. Every month when you pay PMI, that is just to protect the lender. It is of no benefit to you other than it allows you to get in a loan with less than 20% down. So you can see right here, you could be saving over $200 a month between having great credit and bad credit, and that is strictly from PMI. And then if we look at the mortgage, you're talking $910 versus, let's say, $840 for nice numbers, another $60 difference. So you could, in theory, be spending $300 a month you do not need to be spending if you had good credit, or great credit, I should say, because 740 is great credit. So very important. It really does add up for you. And even if you do have not so great credit, it's okay. You get in the house and you can refinance once you get your credit in order. It's not like the rate today is the rate you'll have forever. I have refinanced people multiple times over the last year, and as rates drop, you get better. Now, if rates go up, then yes, your rate is going to be your rate. You're not going to be able to refinance for a lower rate. But you can see that there's a large range here between 640 and 740, more than 0.5%. So that means rates can move a lot and you could still potentially save from a refinance down the road. So very important. One other thing to note, rather than just the cost, is the lower the credit score, the harder it is to approve you for a higher dollar amount. So every lender operates on one ratio. It's called debt to income. It's basically your monthly debts divided by your monthly income, your gross monthly income, not, so that's before taxes. For example, if you have tier 1 credit, we might be able to have that ratio be 50%, meaning you could have $1,000 of debt to $2,000 of income and qualify for your loan. But if, let's say, you're 640, you might not be able to have anything more than a 40% ratio. So now you got a $700 or $800 of debt to that reduced mortgage. So, I mean, you could be talking $50,000 to $100,000 of house between those two numbers. So it could be the difference of qualifying for a $300,000 house or to as little as a $200,000 house because of credit score alone and no other factor. So that was the last point I wanted to make, because it does make such a difference to have that great credit.
Thank you so much. I wonder if we should stop sharing the screen so we can be all on the same page. And we're all alive on Facebook. You guys have any other questions for anything? I checked the Facebook to see if they have any live stream questions there, but I didn't ask for it. So next time.
Yeah. John, thank you so much. A lot of good information. Now we just need more houses on the market just to supply. But other than that, good info.
Yes.
Appreciate it.
Absolutely. Yeah, we need them houses to come up, and maybe with this recent jump in rates that will slow down some of the buying demand. Probably not, because let's just be honest, a year ago, people would still kill for like a 3% rate from a year ago. People would have like chopped off their left arm for, and now it's like, oh, 3%. Like, what happened to the 2.5% from last month?
Right.
Right. Any other questions? Any comments?
Nope. I think we're all set. Thank you so much.
Thank you, John.
Yeah, thank you so much for having me, and I'm honored to have the opportunity to be here today.
We appreciate you. And we are the Alliance Realty Group of Realty Executives Integrity. We have this Ask Alliance every Friday, once a month, first Friday of the month. So stay tuned for April 2nd. And also, if you're listening to us live, we also have Fun with Alliance. And that is open to all our friends and clients and past clients, to everyone we know. John, you're welcome to come and have fun with it. And that's going to be on Wednesday, March 16th at 7 p.m. So that's the next one coming up. Stay tuned for the posts on social media and our websites and via our email. So guess we're good. Thank you.
All right. Thank you. Everyone, enjoy the heat wave outside. It's